right? So we're going to be looking at a strategy update. I'll talk through some of the changes in the core strategy that we are executing. And before we get there, I want to talk about some of the biases that we see among investment um, among the investment community as such, right? So what we think is some of the ways in which you can tackle the bias and how you can use us pretty much like a sort of sounding board, see what we are executing, and you can pretty much plan your industry pieces execution based on how they proposed. So as an introduction, uh, we operate with pretty much a radical transparency. We've got two of my books available for purchase. So if you wanted to develop your own thesis based on economics, feel free to buy the book, build your own thesis based on that. This newsletter on Substack, both SomiVJ.com as well as Allocator's Edge, available free of cost to any um, individual LP or institutional LP, as the case might be. So feel free to use the insights that are being shared on this. Our fund's performance, as well as the weekly changes to the strategy, etc., that we are making, publicly available. So if you want to follow this, if you want to use the insights we get, feel free to use that as well. Now, some of the things that we have been hearing among various, I would say, influencers or some people that I myself have followed over the last few years as talking things related to economics, related to markets, etc. I want to point out some of the major fallacies that we hear and which can be very harmful to your investment journey. Number one, comparing the budget of a country to that of a household or or that of a company, right? While what they are trying to say is there is income and there is expenses, etc., etc. This is how it is, and they say that many of the Western countries don't have enough money. They might be right, but there is one fundamental difference which we get taught in Economics 101, which I think many influencers, despite their knowledge and their training, are missing out. A company or an individual cannot create new money, while as a government, uh, the UK or the US or whichever country you live in, that government will be able to create new money. And they tend to tell you that you know uh, they're trying to raise taxes as a means to pay for services. The government does not need to tax you, right? This is something that you need to understand. There are many Middle Eastern countries where there is no tax. There is literally no tax on personal incomes. Over those governments are. They are also providing, various, uh, I don't know, you know, uh, various public services. The roads are there, the trains are there, the garbage is collected, uh, uh, you are getting electricity, you're getting water, etc. How is that even possible? The government does not need to tax you in order to provide you for all of this. What is really happening? And this is something that we also need to understand as part of the, I can say, foundations for your investment journey as well. Is that many a times we also hear the markets are going to crash, markets are going to crash because of one indicator. So I've been in the market for 30 years. I can't say that the market is going to crash based on one or two indicators. It's usually a combination of point, uh, points which kind of come together, tell us that there is a potential crash. So now there is a lot of fear mongering in that case, saying, there is this certain indicator which Warren Buffett uses, and because of that being on the higher side, the market is going to crash. So you cannot determine that based on one indicator or even two, three, four, five indicators, for that matter. It's got to be a combination of things that have to work in order for the market crash to take place. And market crashes do take place quite frequently, right? We may not know of it, but market crashes do take place. There can be smaller crashes every now and then, which may not get reported in the news. And again, don't get overly worried about these market crashes or these sort of conspiracy theories. Some analysts that I know of are also trying to talk from the perspective of comparing where the market is, like S&P 500 or FTSE 100, to the price of gold, and thereby saying the markets are overheated, etc. You can do a number of these comparisons, but the market has absolutely no compulsion to follow your theory, right? It does not need to say, okay, Robert or Thomas or Somi or whoever it is said, I had to crash. I've got to crash today. Market has no compulsion to do that. Right? That is something that we need to realize. And the markets are way bigger than one or two analysts or one or two indicators itself. Now, uh, coming to uh, uh, how the various macro indicators are kind of stacking up right now. What we're looking at is last week we had an interest rate decision from the Reserve Bank of England. So they reduced interest rates by 0.25%. We are now at 4% bank rate in the UK. So which was quite a expected sort of a move, from the sort of monetary policy uh, uh, from the monetary policy committee. This was quite an expected move, and we expect that the Fed will also do something similar. We can't say at this point in time, but there are a number of pointers that are telling us that a potential rate cut is possible, right? Whether that comes immediately this month or it comes next month is something that we need to sort of wait and watch. Now, uh, this week, what are we expecting? We've had a slight increase in the unemployment rate, right? So, though I'm going to say, okay, the expectation was 4.7%. Right now, the numbers that are coming is 4.7%, which is fine, fantastic. But at the start of the year, we were at less than 4%. Right now, we're talking 4.7%. Now, unemployment rate is not something that you get to see immediately. It hits you over time. Right? This is data that is pretty much of a lagging indicator. It comes in as more and more people report as being unemployed, claim benefits, etc. Thereby, you get to see what is happening in the market. Now, at 4.7%, it's not a worrying number. But I think what we have to be conscious of is the fact that there has been a slow but steady increase in the unemployment numbers. I talked about the fact that governments can create new money. So why are they even taxing you? Why is there this new national insurance for employers and this all that? What they're trying to do really is they're trying to suck out some excess liquidity from the market, right? So they're giving you money. With that money, you will buy goods and services, you will produce something, you will make some income. So that income is getting taxed. And this then goes into the circulation, thereby they can then deliver various public services. Now, another thing to also remember over here is a lot of the money that we talk about as individuals or as businesses is actually commercial bank money. This is not the Bank of England's money being printed, right? And why do I say that? Now, we've used a system of fractional banking for several decades right now, maybe more than 100 years, right? Now, the way this works is central banks have an arrangement with various, uh, various commercial banks, and these commercial banks would borrow from the central bank a certain amount of money, but then what they do is they lend way more than what they have as deposits, whatever. So what we have to understand is loans create deposits, deposits don't create loans. So if you've heard the common man sort of terminology saying, you know, you should move your money from this particular bank because of these reasons and whatever, put it into some, the bank doesn't care, right? The bank is not worried if you take your 10,000 pounds or 100,000 pounds to some other bank. They're not really worried. Maybe a relationship manager that you work with might be a bit worried because their bonus is going to be affected. But beyond that, they're not going to be worried. How they operate is they they basically lend for 10 years, for instance, for a project or for a mortgage, whatever, or maybe 30 years for a mortgage. And then they've got certain amount of equity into this, but then they've borrowed most of the money from the money market, which is other banks, which is other financial institutions that have given them money. So with that, they are able to lend to you. But this money market borrowing works only for the short term. Your loan is for 30 years. Now they have to keep borrowing this over time, and that interest rate can go up or down. Now that is the reason why they're charging you pretty much of a flexible sort of an interest rate. They say, okay, uh, base rate plus 100 basis points, 200 basis points, 300 basis points, whatever is that premium that they have set based on the risk profile for your loan, right? Now, what you do is you take that money, you buy from some supplier, or if you're buying a house, you basically paid that money, to the seller. And what the seller does is less of whatever expenses they had to pay, they will deposit that money. Now, this is where the deposit thing comes in. That deposit did not create your loan, right? Now, I think many of us need to understand these fundamentals in economics because a lot of the market nonsense that we hear from so-called influencers is absolute bullshit. And the reason why I say that is they are trying to propel lies and create fear when there isn't a real reason to be fearful about. Now, many influencers have also said the UK has run out of money. The UK has not run out of money, and the UK will not run out of money. And if it runs out of money, it can print more. It's never going to be a problem for the UK, and you don't need to worry about that as well. As long as you have money in the bank for basically for you to pay for your essential expenditure, that is all that you need to be worried about. And what is it that you're going to invest in, etc. Uh, the other thing that we also hear a lot is uh, what I call as I can probably call this as a sort of recency bias, right? So today there is some news in the market, and then immediately I want to make uh, an investment into this, and then I want to say, okay, fine, based on this, I think the markets are going to crash. I'm going to book the profits. Now we saw that a lot in the past, right? Uh, take the case of the Magnificent Seven, sorry, Magnificent Seven, Mag Seven, right? Basically the tech stocks um, that have pretty much the highest market cap, um, you know, $1 trillion market caps, whatever. Now, many people said over the last few months and whatever, They said, the stocks are going to crash and you have to book profits. For all those who book profits, yes, the stocks at Max 7 did have some declines, but it basically recovered from there. These are fundamentally sound businesses, right? And these businesses operate in ways that you don't understand looking at it from an industrial lens. If you compare Meta or if you compare Tesla or maybe Nvidia to basically a manufacturing firm, and then think that's what the valuation should be. Sorry, it is not in the same sector. It is not comparable to a manufacturing firm. It is not using the same sort of a business model. So it's going to be quite different. You either try and understand the sector, or you listen to others who have kind of done the analysis and basically made that sort of a determination. Another uh, pointer that we keep seeing very frequently here, and how Helix tries to sort of mitigate this is we assign a lot of weight to an initial piece of information, right? This piece of information could be that um you know uh, take the case of Tesla, right? Tesla has got this new order and this new method, this new thing. This is how it is. Yeah, fantastic. And to be honest, it is a great company. I don't deny that. But don't base all of your investment thesis on just the recent piece of information or just the initial piece of information that you've used as the sort of anchor. We call this as an anchoring bias, right? So many of the times we find that investors make faulty investment decisions, and these faulty investment decisions can pretty much lead to a lower return on their portfolio, and sometimes actually, uh, you know, some level of losses as well, right? So don't misjudge uh, the true fundamentals. That is one. Secondly, don't put too much of emphasis on a arbitrary price band or whatever, thinking that you know trading within that particular band is where that particular stock will perform or whatever. Right? The stock has absolutely no reason to follow your thesis, and the market is way bigger than just one particular person's thesis or whatever. So what we do is we avoid single metric sort of analysis. And this is the reason why we check historic prices. We then look at how the price has performed over time. And then we can establish various systematic assessment approaches for each and every sector. And then we can compare that sector to the broad market. And within that sector, we can compare you know, the stock to other stocks in that particular sector. So with that, we will be able to see whether the stock is outperforming all the peers, or is it pretty much the same as the peers. Right? This is something that we do all the time, and when we are making a recommendation, you will see in our signals that we've made a recommendation for a particular stock, and that is based on these kind of analysis. We are not making that determination based on just one single metric alone or just the valuation alone, just because it is undervalued, go and buy it. So no, we don't do that. Another thing that we see is many investors do is kind of a outcome bias. Uh, Judging the quality of a decision based on the outcome than the quality of the decision making process at the time it was made. Right. So uh, a great example of this is people chasing, meme stocks or hype stocks because they gave them 20%, 30% returns in the past, right? Quantum computing, space, uh, space technology. You've got Bitcoin mining. You've got these are all emerging technologies for sure, right? These are all, and uh, while there is nothing wrong with investing in an emerging technology, what we have to understand is the businesses that you are investing in have not made a single dollar to date, right? And your performance in the past has been based on a market hype. So that hype may not play out in the future. So don't chase the performance and don't repeat the bad decisions. If you already had one lucky outcome, book the profit on that. Stay away from something like this. Uh, what we tend to do is we focus on the process over the outcome. So the process is quite sound. Process of determining uh, the money flows, the macroeconomic conditions at any point in time, how we look at basically the GDP numbers that are going to come in, inflation numbers that are going to come in. In the US, we are expecting basically the inflation numbers coming in later this afternoon. In the UK, we're going to look at basically the GDP numbers coming in on Thursday, and in the US, we're going to be looking at you know the retail sales numbers coming on Friday. So how we look at these information and then uh, evaluate decisions based on the information that is available at the time of that decision. Right? We ourselves, we are analysts. We are not gods. We cannot determine something that might happen 5 years down the line. But what we can do is we can assess based on information that is available to us today, and we can assess on the basis of uh, how it has played out in the market, and we observe the market very regularly in order for us to get a much better understanding in terms of how things are working. The uh, one other bias that I want to talk about, I think I talked about confirmation bias or confidence, herd mentality, etc. in my previous blog post. So I'm not going to repeat all of that again. But one other one that you know um, I tend to look at is what we call as a sunken cost uh, bias, or you can call it as an endowment bias, right? So sometimes we find investors holding on to losing or potentially loss-making investments due to a emotional attachment, or they say, okay, this can change in the next 1 year. I'm still going to hold on to it. It might be actually better to just cut the losses at this point in time, find an alternative use for that money, right? When you know that you have made an actual loss on the investment, not just emotional, but it's an actual loss and it is increasing over time. Let's say over month on month, quarter on quarter, your loss is increasing. I think it's a better outcome to cut those losses and invest that money into something else, which is safer, risk free, safer. You can even go in for maybe a government bond or a ETF based on treasuries or based on UK bills. You can invest in that. You can get 4%, 5% returns out of that instead of the losses that which you are generating currently. So that's uh, something to be aware of. So in combination, if you look at it, the endowment bias, the outcome bias, the anchoring bias, recency bias, the herd mentality that we see a lot among investors, overconfidence, the fear of losses and loss aversion, and most fundamental biases of all, which is called the confirmation bias, tendency to look for uh, information that kind of confirms one's own beliefs, So in combination, these biases can limit your portfolio's earning potential. The the returns profile of your portfolio would be significantly lower because of these biases that you hold. So when analyzing the uh, portfolio of a few family offices, we found that the impact of biases can be anywhere between 10 to 12% loss of returns. The fact that there isn't one clear thesis, or you're going after multiple investment theses hitting everywhere, meaning there isn't one common theme behind the thesis, and essentially forming some sort of a vision for the future. So without that, uh, the impact to returns can be 5 to 7%, right? So the thesis can, having a strong thesis backed by market research and understanding how the sectors that you want to invest in are performing before you make those investment decisions. Forming that thesis can actually add about 5 to 7% returns to your portfolio. Avoiding the biases and using a strong mitigation strategy, like not looking at just one parameter while making that decision, not just uh, seeking information based on a preconceived notion, right? uh, Having that ability to cut the losses and move on to something else. So that's sort of a mitigation strategy. If you implement something like that, then that can again add anywhere between 10 to 12% additional returns to your portfolio. So if you are making 10, 12% today by adding a thesis and on top of this, and by limiting biases, having a strong mitigation strategy, you're talking maybe 25% and above on your portfolio. Uh, Anyone can do this. It does not need very, 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 very specialized skills. It does not need, uh, you know, excessive use of technology. And I say this, in a lot of times. And the reason why I'm sharing this information again and again on our live sessions is learn from the markets. And the markets are teaching you every single day. And a lot of the work that we do in investing is not just analysis. You're trying to synthesize information from multiple sources in order to make that determination. So as an example, you might think, okay, this stock is experiencing maybe a earnings surprise. So every time there is an earnings release, the stock price goes down. So this time again, stock price will go down. Maybe I will make a short position on this. So that is basing all that information on one metric. Now, what if I told you that stock was actually undervalued? So when the price correction happens, it's going to be further undervalued, and you have the possibility to go long at a very low price. Hold that 6 months, 1 year, you will be making 20% on that, right? Now, what I have done here is I've just connected two pieces of information to make that determination. You can do this. Everyone can do this. Uh, how to learn about, thesis development, how to get the latest, we run an emerging manager program. So if you want to join in, please let me know and we can help you with that. How to invest in our fund, go onto our website and there's information about our fund and you can set up a call with us in order to discuss this further. Uh, how to use our advisory services. There's also information on our website directly. Go ahead, hit helix.earth and find more information over there. Send us a message or fill in the form out there and we'll get back to you with more information. Thank you. Nice talking to all of you. And I look forward to hearing more about your investment journey. Thank you.